This particular chart shows commodities compared to equities. So real tangible assets compared to the stock market. And I love this chart because if you go back, we can really see it makes sense. So underneath this median line here in the 80s, right, we had equities that were overvalued. But as they lost value, right, in the early 90s, stock market lost about 20% of its value, and suddenly there's a spike in oil prices. Well, you expect to see then the commodities might be overvalued compared to equities. That's anytime there's a peak up here above the red line. But then the opposite happens as we move into here, the early 2000s, late 90s and early 2000s. What happens? Well, that's the dot-com bubble. So obviously equities are seriously overvalued compared to commodities. So that's what we see here. Now, as the dot-com bubble bursts, what happens? There's a sell-off in equities. People realize that they're tremendously overvalued. There's a rush out of equities and into commodities. Same thing here, 2008, 2007, 2008 strikes. What happens? People realize that they need to be in commodities. Now, what's concerning to me is look at where we were down here in the late 90s and early 2000s, right? Where are we today? We are lower than that. We are far lower than the dot-com bubble, meaning that the fallout that we could see today is even more significant.